State Treasurer, Mr. Moore.
Here.
Representing the State Controller, Ms. Paquin.
Here.
Ms. Higa.
Here.
Representing the Director of Finance, Ms. Ortega. Chairperson Rosenstiel, you have a quorum.
Thank you. Thank you. So our first item of business is the approval of the committee agenda. Somebody like to move approval?
Move approval? I'll second.
Okay, all in favor?
Aye.
Opposed? Abstained? Okay, great. Then the next item is the approval of the minutes of the June 7th, 2017 meeting of the committee. Okay,
Second.
so it looks like we have a motion and a second. All in favor?
Aye.
Opposed? Abstentions? Great. Okay, so number 3, the progress on independent financial statement auditor's management letter. It's on the consent agenda, but we actually have an issue that we want to take it off of consent so that we can discuss one of the issues. And I need to get to that place here. So the question that I wanted to raise, Larry, and has to do with the on ARM 9, the log and account monitoring, which is a repeat finding, and the presentation, the materials we were given, says that there was the original target date was not met. A new target date has not been established, and I'd just like a little bit better understanding about what's holding up the addressing this issue. It seems that you know, something that was a finding that needed to be addressed. According to this report, there isn't really progress being made. I'd like to understand why that is, and who, you know, if there's a management decision that it's not a priority and therefore it's not being addressed, I'd like to understand that.
Okay. I think I want to just direct your attention to the paragraph here right after where it says, that's underlined where it says start CalSTARS operating system administrator accounts. There's that paragraph that says the reporting and review of the start administrative activities have been remediated as of October 2016. And that's what's really the most important part of this finding. We had our financial statement auditors, Crow, who cited an issue, and this was as of June 30th. As of October, it was remediated, so the controls is now in place. However, it's a manual process, and so what they were looking at doing is trying to enhance it through an automated process. And so that's the goal that they set for December 2016 was how can we maybe automate this process? And there's a dependency upon OTEC to do that. And OTEC is a mainframe, they have a mainframe system there, and quite frankly, I've had a subsequent conversation with the ISO, and what we learned is just they can't provide that to us in a compatible file format, if you will, from this older mainframe system. And so they will continue doing the manual review until we don't have that kind of dependency upon OTEC. And as we implement the new pension solution, we'll have that ability within the pension solution to provide this type of monitoring from an automated perspective. And so I think, again, the important part is that the control is now in place. It's remediated. It shouldn't be there as a subsequent issue in our findings from Crow this next year. And they were just looking at a way to automate it and enhance the process, though.
What's been held up is automating the process, yes. And that will be addressed and incorporated when pension solution goes live.
Correct.
Any other members have any questions on that issue or anything else on this agenda item? No? Okay. I'm including Bob as in.
Just real quick.
Yeah.
This happens all the time. There's absolutely nothing wrong with it. So from looking at it from ISO's perspective, the issue was an electronic match, and they couldn't do that. So when you read the right-hand column, it sounds like, gosh, they're kind of blowing it off. That's not the case at all. It's just, well, that's not feasible technologically, but that's how they were viewing it, as opposed to, well, the control is in place, but it's a manual control. So it's just sort of how reports get put together.
Good.
That's all that
Yeah,
happened.
thank you. Okay, so item 4 is the fiscal year 16-17 audit plan, the progress report, and I guess that's Cheryl and Mike? Or Larry introducing it, but their names are by this agenda item, which is why I
Right, this is
went
our
straight to them.
This is our semi-annual audit plan update that we bring to the committee. The standards require that we periodically do this. And as we transition to the new committee meeting schedule, we typically wouldn't bring this back until September. But because of our busy November meeting, we thought, let's just bring a periodic update back to you now. So this interim report is what we're providing. We'll bring a full report of accomplishments provided at the November meeting. And so the standards require that we do this. You know, I think that it's a very good report. I'll let Mike Dutel, who's the senior manager of our employer audits, and Cheryl Dietz, who's the senior manager of our internal audits, briefly discuss their accomplishments this past year.
Thank you, Larry. I'm happy to report that as of May 31st, the employer audit team completed 58 audits. As of June 30th, we completed 60 audits, which exceeded our annual goal by 2 audits. A summary of results, including a detail of employer audit findings, is included as Attachment 1 on pages 19 through 26. Overall, we found a total of 90 findings. Of the audit findings listed on ARM 24, the most common finding we found was earnings were misreported to the defined benefit program. This finding was found in 59% of our audits. Second, we found post-retirement earnings were misreported in 47% of our audits. And third, unused sick leave was misreported in 38% of our audits. As noted on ARM 26, we found systemic findings in 27 out of the 58 audits that we completed. The majority of the systemic findings pertain to extra duty earnings and limited payments. As part of the corrective action for systemic findings, we asked the employer to provide a list of additional members outside our audit sample that were misreported during our audit period. As of May 31st, 18 of the 27 employers responded to our request and identified 3,385 additional members that were misreported to CalSTRS. However, to date, 20 of the 27 employers provided their list of members affected by the systemic findings and identified a total of 4,622 additional members that were misreported to CalSTRS. In addition, 3 other employers responded but have not yet provided their list to us. We continue to share systemic finding information with benefits and services so they may work with the district to identify additional members affected by the finding and to ensure that the payroll corrections are submitted timely, and to provide the district additional training to ensure that these finding types do not occur in the future. As noted on ARM 25, 6 audits were appealed since July 2016. I would be happy to address any questions the committee may have regarding the employer audit update. Thank you.
Don't see any questions, but I have one, which is when we identify 27 employers with systemic audit findings, and then we go back to them, and it sounds like 20 have responded to us, but the other 7 have not. What do we do in that situation, and what authority do we have to? I mean, here we know there's a problem that probably is pervasive at that district, but we're not getting a response. What?
If you look at ARM 26, it'll show the actual districts that did respond. And if you notice, the majority that haven't responded are the ones that the audit report was just recently issued within the last 90 days or so. And if you look at some of these, one district had 1,800 employers that they had to go through their records and identify and report that back to us. So it does take the district quite an amount of time. and resources for them.
So it's
to do that.
mostly just a question of giving them time to respond. It's not like we find that districts
That's probably the main.
just choose
main
not to
factor.
respond.
That's right.
Okay. Okay.
Our program area, continues to work with them and we reach out to them, we encourage them, and then also, I know in fiscal services, they've been looking at, can we apply penalties and interest in ways that we can help motivate that reporting, and so let Robin.
Yeah, so we do have authority to set an adjustment requested date and then penalize if it's not responded to in a timely basis. Operationally, we're still working through how to make that a regular part of our strategy. And then we're actually thinking about additional, whether it's legislative or regulatory language that would allow us to penalize for gaps after a certain period of time, which is a hole in our current regulatory structure. So if we got non-response, one of the existing process allows us to penalize if they take too long, but the question becomes, what do we do if they just never respond? So it is on our radar, and we are considering it both in this situation and then also when we've got gaps in reporting from individual employers for our regular contribution reporting, so.
Have we ever had to utilize our ability to impose a
Yes, we have,
penalty?
and it was a significant amount to a large employer, not related to an audit specifically, but we have done it.
Okay. Joy.
Thank you. So I have a question on ARM 25. There's a table on the top of that page that shows for the past 6 or 7 fiscal years, the employer audit appeals. And I guess I have a question about a column that says appeals remaining. I mean, there are some appeals that are, most of them are from the last 2 fiscal years, but there are some that are, pretty old from back in 10, 11 or 12, 13. I guess I just was curious about if you could provide any more information about the types of appeals or the types of issues those address and, kind of what the path is toward resolution, since some of them are several years old.
So
And if we don't have detail, I mean, I guess I just wondered if there was just a general comment you might make about the types of appeals that are that old? or- Okay.
Yeah, so with regards to the outstanding appeals in ARM 25, there's a wide variety of reasons why they're still outstanding. Some of them could be multiple appeals that have gone through the administrative hearing process, then got up to the writ, and potentially are up on the Court of Appeals. And so it could be a pending process that's outstanding. And some of them, I believe, are still just in the process. They may have added additional employees to it. And with regards to getting the statement of issues filed and proceeding on with the administrative hearings, it just, for one reason or another, may have been taking a little bit longer than initially anticipated.
Okay, so of the ones that are, so the path for resolution for all of the appeals here is to go through the regular kind of appeal process that would go through a hearing or potentially go into litigation or,
That's
okay.
correct. Once the final audit report is issued and either the member or the employer have any remaining contentions left, then it would come up to legal and then we would start the administrative hearing process. And that process, depending on the scheduling of the parties, the scheduling of the Office of Administrative Hearings, where the hearings take place, just depending on a number of issues, may take anywhere from 6 months on to have that process be initiated and then concluded.
Okay. Yeah, I think when I read this, I was thinking about it in terms of issues that came up through an audit that might not be, member or case specific, but were kind of open audit items. So I think I was kind of conflating the two. So thank you.
That's a really good point. When an employer responds to an audit, usually if they have any objections, they'll outline those for us, and we work really diligently with them to try to resolve all of the issues that we can fairly before we issue our final audit report. And then once we do, then that becomes a determination from that point then it's all the legal proceedings.
Okay, that helps,
Yeah.
thank you.
I think one of the important parts of this is that underscores, what we talked about at our last meeting with regards to charter schools and the systemic issues there, that the impact on the population of charter school members is very, very small, right? An average of 45 members for the schools, whereas you see here where we looked at, 113 different members and identified almost 3,400 reporting errors in these larger school districts, then the value of that to the organization is far greater, and it underscores the importance that we focus our resources really on, auditing these larger, high-risk districts as outlined in the report here. And when we present our risk assessment to you, we talked about kind of making sure that we keep the right focus and applying our resources in the right area. And I think this demonstrates, that it works. And we're able to identify with just a sampling methodology a large number of reporting errors. Okay, Cheryl?
So as of May 31st, we've completed 3 audits since our last report to the committee in April. And an executive summary with the objectives and results are listed in ARM 29 to 31. Our next report in November will provide an update on the status of these findings. And I am pleased to announce that as of June 30th, the remaining audits listed on ARM 17 have been completed. This includes an audit related to Information Security Incident Response Plan. Then for the specialized audits listed under contracted reviews on ARM 17, we facilitated 4 audits, and as of June 30, 3 of them have been completed by the external audit firms, and 1 remains in progress. That's all I have. If you have any questions.
So the full report of all of the audits that were completed will come back to the committee at the November meeting. And that will not only include those results, but the external firms that conducted these audits will be presenting those to the committee as well and discuss any findings that they had. And, we did include those 3 reports that Cheryl mentioned in here. We provided an executive summary. In the past, we provided you with a fairly lengthy summary of the report. We tried to make that a little more concise. And also we pointed out kind of what are the noteworthy practices that we identified and what are those things that are working well in the business areas when we go in and do our audit. But then, of course, we also outline opportunities where we identify areas that we could enhance controls or and improve operations. And so I hope that you find that format better or more consumable for the board, and we'll, if so, we'll continue using that going forward.
I have a question, Lynn?
Thank you. I was curious on the pension solution internal audits that were completed as of the end of June. Have those results also been shared with our consultants?
So are you talking about the pension solutions governance and the pension solution data conversion?
Exactly.
Yes, those haven't been finalized. They're in draft form.
Okay.
So once they are, I do know data conversion has been shared with us, CGI.
Okay.
Yeah, we worked really closely with them actually throughout the whole process, and so they're very familiar with the issues, and we've had ongoing discussions with them.
All right, and those will be available to the board in November?
Mm-hmm.
Mm-hmm.
Okay, thank you.
Bob, did you have something to say? Looks
Thanks,
like you
Paul.
do.
Just real super quick. So Cheryl said something, and you probably it snuck by it, but she said that the audits on 17, which was sort of the schedule for internal audits, you can think of that. These are what we have to do, and then she said, and so we did them. That sounds pretty innocuous, right? but it's not, because this Larry and I were just talking. This would be the first time in a while that I can recall that you could say that. That I can recall, and I think they were 1 person down. They were light a little staff, and so I just want to say, thanks.
Great, thank you. Okay, anything else on this item? So moving on, item 5, fiscal year 16-17 quality assurance review corrective action update. Larry?
This item is coming back to the committee at your request. As you might recall, last year we had what's called a quality assurance review. as part of an ongoing quality improvement program, every 5 years, we have an external firm come in and review all of the work that Audit Services performs. And it's kind of like who audits the auditor. And so they look at our work first and foremost to ensure that it's performed in compliance with the standards and that it's sufficient and adequately supported and that the conclusions are well documented. So those are really important, the most important part of that. And in this last review, we didn't have any findings that dealt with compliance. And so as part of the review that they performed, though, they offer some value-added kind of recommendations, if you will. And what they focused on here was kind of an opportunity for us to elevate our staff through staff proficiency and increasing business acumen, as well as increasing communications with the program area, and then some value-added data analytics kind of initiatives there. And I think what's important in here is that, first of all, there was no non-compliance issues with the standards. And that's what's most important for the committee to recognize. And then these other areas here are things that we're working on internally. They're accomplishments, and I'm asked Cheryl if she can just summarize a couple of those things that we did there. But before she does that, the last bullet point on ARM 32 is we've encouraged our staff to obtain professional certifications, and obtaining the certified internal auditor designation and certification is really kind of the hallmark of our profession. And it provides a level of assurance to the board that first of all, staff are conducting their work in accordance with the standards, they're familiar with it, they're tested at a level with regards to their business acumen. And we have a couple of staff who actually are here today, if I could just take a minute and introduce them to you, that have made some significant progress in this area. And so first of all, I'd like to introduce to the committee Vicki Zong. And she, go ahead and stand up there. Yep. Vicki has been with CalSTRS for about 3.5 years now. She just passed the CPA exam when she came here. She has now also passed the Certified Internal Auditor exam and is currently studying for the Certified Fraud Auditor exam. And so she's made some terrific efforts there, and I think us being able to recognize her in that area, and it just helps them with their credibility and their efficiency in the work that they perform, and she's done a really great job. Another staff person who is not here today, Emily Nguyen, also passed the CFE exam and is currently studying for the CIA. CFE is a Certified Fraud Examiner, and she's passed that, and then she's now studying for the CIA exam. And she's been with us for about 2.5 years. And so we've seen some really terrific advances there. Also, another staff person who is here on our internal audit team, Leah Escoto, is here. She's been with CalSTRS for about 7 or 8 years now. She has passed 2 of the 3 parts for the CIA exam here recently, and she is now qualified as what we call an internal auditor practitioner, having passed parts of the exam. And so I think it's terrific where staff are making this effort. They're doing a lot of it on their own time. We're supporting them, of course, with regards to materials and things like that, but they've taken the initiative, and I just want to recognize them for their efforts, and it's really a hallmark of our profession.
Thank you. That's great. Congratulations to the 2 of you and to all of the others who are doing that.
Yeah,
and
we
it's
have
great.
several others who are in progress
Yeah,
too.
it's great, Larry, that you're upgrading the quality of the staff. That's fantastic. I got a couple of committee members to speak. Harry.
Simple request. Are we in the Central Intelligence Agency, the CIA? What is the CIA? I'm a little nervous. I'm generally nervous, but my...
You see when I wear my hat that says...
Yeah, it's
The one thing we get to say that sounds cool.
Certified Internal Auditor.
much better.
Yeah, sorry about that.
Much better.
Frank?
Do you reimburse staff for getting certified, the classes that they take and the actual test itself?
Yeah, consistent with, CalSTRS training policy, we actually buy materials for them. And we do actually reimburse them for the exams and pay for the exams and things like that to a certain extent. So what we've worked out is kind of like, we'll pay for the first one, we'll reimburse you for the second when you pass.
Good.
So,
Lynn?
Thank you. This is an impressive improvement plan that you have listed, and commend everybody for all the efforts and the training. I had a question about one of the items there, and it said that staff were encouraged to use data analytics in the internal audit process. Can you describe a little bit about what you look for and how you would implement that?
Data analytics is kind of a new area that, consistent with best practices, internal audit shops should have some use of data analytics in order to enhance one of our sampling methodology, our scoping of audits, and then also our risk assessment process, where we can take the data and analyze it for the specific area that we're looking at, right? And so one of the things, though, about this is that it kind of turns into a little bit of a fad, big data, right? You got this big data. Well, you got big ideas and you got big failures sometimes. And so what we're really trying to do is take a strategic approach on how to implement it and how we can use it in our audit process. And so, for example, we have worked with our enterprise information management area that is designing some reports that can be produced in the pension solution that will help us with risk assessment. And I'll just give you a couple of ideas, and we've given them a dozen or more, but some of them are also kind of related to fraud activities or just issues that we want to look at. So, for example, do we have a benefit payment, multiple benefit payments that are going to the same address or that use the same Social Security number? Those types of queries that we can do in order to really help us understand. That doesn't mean that that's a problem, but it means that we need to understand why that's occurring and what's happening. And so there's several scenarios, if you will, that we've put together that are looking at how to extract that data that can benefit us. Sampling methodology, it helps us when we take a sample and we can look at an issue, and we've done this recently where we had a payment that was it was an error in reporting. It was a $2,000 payment that went to defined supplemental plan versus the defined benefit. And we could use a data inquiry to really identify all of the $2,000 payments that were made, and we can see exactly who those payments were to. So it was helpful that way. We didn't have to go out and audit each person there. In fact, we didn't even have to ask the district to identify it. We could see exactly who was there, and fiscal services really, initiated that. But that's another way of using data analytics, and so we're looking at how to really thoughtfully do that without just taking data and, not just to have data because it's there. Once you have it, I mean, the more data you have, we're trying to develop how can we add more value from that data.
That's great.
So we're slowly approaching this, though.
Thank you.
Anything else, Larry or Bob, or?
Well, so going back a little bit of history, like why is this report here?
Yes.
And so in 2011, we had a QAR, and there were some non-compliance with standards, with what we call Red Book standards, IAA.
Institute of Internal Auditors.
Yeah. And so the board asked quite reasonably, can you keep reporting, bring this back to us so that we know the status of these non-compliance items. Then we had a QAR just recently, 2015, the next one's 2021. 16, sorry, the next one's 2021. The 16 uncovered no similar deviations from standards. So what these were is just a set of value-added suggestions from the auditor. Maybe sort of best practices idea, but certainly not, hey, there's a problem, you need to fix that. And so my recommendation would be that, in my opinion, the board obviously should see things that are relevant and that should be brought to it, but this may be information overload, and I think this is something that maybe going forward, this particular report, I don't want to see it again. And I don't know, Larry, what your thoughts are on that, but.
I agree. You know, this is just, it's management of the office, it's things that we're doing on a routine basis, and it's something that you would expect us to do, but it's not a deviation of standards. And, you know, I brought it back because the committee asked us to, but I feel like if there's no significant issues with regards to the QAR, then it's probably not necessary to keep bringing an annual report back.
Anybody on the committee have anything to say about that, or? Sounds like the committee's fine with that, so we'll, thank you for doing it this time, and we'll await the results in 2021. So,
Stay tuned.
Stay tuned. Okay. Larry, the chief auditor update.
Well, as you can see, we've been busy wrapping up the internal audits plan for fiscal year 16-17, and then we're kicking off the new plan, and we've started some preliminary conversations that the board just approved at our last meeting there. And so that's been the majority of our time. However, I did want to make sure that you're aware that CalSTRS, along with CalPERS, will jointly host a conference for the Association of Public Pension Fund Auditors in November here in Sacramento. And this is where auditors from approximately 40 public pension systems across the United States and Canada will be attending this conference. And I know what you're thinking. You're probably thinking, you know, that sounds like a lot of fun, getting auditors together, but it really is a great networking opportunity for us to discuss kind of common issues across the funds, and we get some specialized training like on enterprise risk management and cybersecurity, and you know, implementing large IT projects and best practices for internal auditing. So it's really a great opportunity for us, and we've been working on that, and we look forward to that here in Sacramento, and so it's a privilege for us to be the host. Also, I just want to let you know that our 2016-17 financial statement audit, it's well underway. The GASB employer audits are coming to a conclusion now. Crow was here and they completed all of their preliminary work. No big issues surfaced out of that. They'll return at the end of this month, and then they'll be on staff kind of full-time, full-time until the audit's completed. And then the results of that audit will come back to the committee at the November meeting, at our next meeting. So I just want to make sure you're aware that that activity was underway. And that concludes my report.
Great. Any questions for Larry? I don't see any. Thank you, Larry. So Brian, the Chief Compliance Officer update.
Thank you. And to satisfy my good but frosty friend, Dr. Yetman, I want to at the outset say that this is a brief a progress update, not a program update. And the reason I mention that is at the last committee meeting, we received some wonderful input and guidance from the committee and from Dr. Yetman, specifically about roles, responsibilities, structure, framework, resources. And we are working on addressing those questions and providing a detailed response. Since our next meeting is not until November, we are working on putting together a written, detailed response to those questions with an attempt to then, from that, work with the chair and vice chair to construct an agenda item for November that moves the program forward with the appropriate scope as determined by the committee. I'm excited to tell you that we went through another recruitment process. We received some applications from some very qualified candidates. We've gone through a number of interviews. We have identified a finalist who has interviewed with executive staff and staff. We have one more one more executive interview to conclude. And then I think it looks very hopeful that we might have somebody in place by the end of the month, assuming that those contingencies are met. In that case, I'm suggesting that we put together the report that I'm discussing and get that to you around the beginning of October. That will give this person 2 months on the ground to try to absorb some of the questions, the guidance, get a little bit more information. Meanwhile, we're proceeding on some of the specific guidance to get ready for that such as the inventory analysis of the organization, regulations, laws and regulations, and create that, circumscribe that universe for you and put that in a reportable format. And so we have interviews and questionnaires for each program area, as well as input from the legal office to identify those crucial areas. So we're excited. We're moving forward. Progress has been slow. I admit that, but we are. The guidance that we received at the last meeting was gave us an incredible boost, a little bit of extra energy. So we are proceeding along that path. So I'm happy to answer any questions, and hopefully I have not offended my good friend, Dr. Yep.
I don't see any questions. Now I see one. Joy.
Brian, what was the report you said you plan to have prepared at the beginning of October?
Yeah, so it's a good question. It really was trying to focus in on some of the questions that you and the committee members raised, and it would be focusing really on the risks. So there's a question about what are the risks that we're trying to address, what are the goals, what are the responsibilities that we see for the ARM committee, that the scope of their responsibility and oversight. One of the questions that was asked, is it enterprise-wide? Is it taking on every single legal risk in the organization? Where does investments fit in that was one of the questions. What's the scope of the program? What's the recommended scope of the program? Obviously, you will approve any of those items, but that was one of the questions, is what's the scope of the program? What's the framework? I think that was a very basic question. What's the framework for the program? And what are the necessary resources to make it successful? Do we have the resources? If not, what's the right size resources to start down the path to be successful based upon the framework? So we wanted to present that to you in some detail with some real effort behind it to try to answer some of your questions, again, so we could fashion some specific work for the November meeting, again, with based upon that initial report. We didn't want to go all the way till November without providing any response to the detailed questions that we were asked.
And if I could just some thoughts on that, I think hopefully it's going to be brought back to us in the form of sort of an integrated plan, as opposed to answering, like question 1, question 2, question 3, right?
Yes,
I think that's really where we're trying to get to, is to see, the plan of what we're going to ensure compliance with, and how are we going to do that, and hopefully if we can hire somebody and that person can be on the job for a couple of months before a draft of this is shared with the committee leadership, I think that'd be great. Obviously, you will let us know if something happens along the way and we're still in a search mode rather than hiring
I think you
mode.
might be the first to know.
Okay.
After you'll hear me screaming. So.
I'll hear it all the way in San Francisco. Okay. Anybody, Bob, do you have any thoughts? Okay, well then, great. Brian, thank you very much for the update, and we look forward to hearing about your progress. So, okay. Now we're all going to get educated about the impact of GASB 7475 on CalSTRS and employers. So, Robin.
So I have a couple of opening remarks. The first is to introduce the staff who are going to do the work here. Art Martinez, who is our Director of Financial Reporting and General Ledger, and Lucy Arbuckle, who is a virtuoso, and also our Interim Accounting Director. But In her prior life here, she was the senior manager of the financial reporting and general ledger area within Art's span of control. And so she's been instrumental, as well as Art, in deploying these standards. And that's the reason we wanted to come before you today, is that we are actually preparing our financial statements under these standards. And we wanted to make sure we provided you some background before you saw the results of the audit that has incorporated these standards. And hopefully we can provide you with high-level information that makes these familiar to you without going into details that are not helpful. This program does represent a fairly small portion of our overall portfolio, but it is a standalone column on our financial statements. And so we do have an obligation to prepare financials for that particular fund in the same way we do for what we call our big fund, the State Teachers Retirement Plan. So with that, I'm going to turn it over to Art, and we'll go through what we've prepared for you today.
So just to start out, GASB continues to be very active in establishing new accounting standards. So over the last few years, we've had to implement several. As you'll recall, we implemented GASB 67, 68 recently, which dealt with pension accounting. We also last year implemented GASB 72, which dealt with fair value measurement. And so now we're, like Robin said, we're focusing on the implementation of GASB 74 and 75. So Lucy and I are going to provide you an overview. I'm going to go into more of the details of the standard, and then Lucy's going to talk a little bit about some supplementary information that we're preparing to assist the employers in their implementation of GASB 75. So starting out, GASB 74 and 75 really deal with the financial accounting and reporting for other post-employment benefit plans, so OPEB plans. And OPEB plans really cover healthcare, dental, long-term disability, so sort of those, all the other type of benefits that your regular pension plan wouldn't cover. So under GASB 74, that's applicable for fiscal year 16-17. So that's the addresses or sets the accounting standards for financial reporting at the plan level. Again, this is an accounting standard. It doesn't go to set policy with regards to how you go about funding the plan, how you go about setting contribution rates, or it doesn't even require that a plan be funded. Under GASB 75, that really deals with the financial accounting and reporting at the employer level, the employers that are participating in an OPEB plan, and that'll be applicable for 17-18. So again, GASB 74 sets the framework for financial reporting at the plan level. This standard is very similar to GASB 67. So many of the terms that we'll be using, many of the concepts, methodologies are very similar to that standard. Again, it's a standard that doesn't dictate how you go about funding a program or setting your contribution rates. And this standard will impact our financial reporting for the Medicare Premium Payment Program. And so just to provide you a little bit of background on that program, it's a cost-sharing multiple employer OPEB plan that's administered within our Teachers Health Benefits Fund, which, as Robin stated, is separately disclosed within our financial statements, within our balance sheet and operating statement. It's a cost-sharing multiple. It's also, the program was established to pay for Medicare Part A premiums and also Medicare Part A and B surcharges. For those participants or retirees that are part of the DB program or were part of the DB program that met certain eligibility requirements. And to understand a little bit about our approach for implementing the standard, because this is a little bit of a unique program, you have to go back and look a little at the history of the program. So back in 2000, the Teachers Retirement Fund was super funded. And so at the same time, there was a difficulty in, I think, retaining and hiring teachers. So they looked at this program as a way of attracting teachers, the establishment of this program. So at the time, what was done is that they set aside approximately $1.3 billion from an actuarial perspective to fund the program. And so that's important to note because we didn't actually transfer the assets from the Teachers Retirement Fund to the Teachers Health Benefits Fund. We actually kept track of those, or it's done through the actuarial valuation where they're keeping track of that surplus. Subsequently, in 2008, it was it was determined that the amount that was originally estimated as the size of the program was greater than what the participation rate was projected to be. So they reduced the amount down to $625 million. $625 million to fund the program. So just to give you a little bit of information with regards to the scale of it, at June 30th, 2016, there were approximately 7,000 members participating in it, or retirees participating in the program, and we paid approximately $30 million in benefits out of it. Did you have anything you wanted to add with it?
Yeah, just as, again, by way of background, I mean, it was very wise of the board not to transfer those assets, because if they had been transferred, we wouldn't have been able to recover them into the strip until the actual program was ending, or we had a certain projection of the liability of the program. So part of the rationale for not moving the assets was to protect the state teachers retirement plan from the drain of these assets should the benefit not need that allocation. And again, we're seeing as this program winds down that the level of cost is, again, understating the estimates that were even updated in 2008. Now, the other thing I want to make sure we're clear on is we also pay Medicare benefits on behalf of our retirees. So we do a lot of deduction of Medicare premiums from our actual benefit payments. But this is the portion of that we are actually providing the insurance for. So I just wanted to make sure, you know, when we talk about Medicare a lot here, and there's really two kinds. One is a voluntary deduction that we take out of the ongoing allowance roll, and the other is this actual premium payment that we're making. And so there are complexities in how we administer this that are exacerbated by the fact that we have both those parts.
So with regards to GASB 75, again, this sets the financial accounting and reporting for the employers that are participating in an OPEB plan. It's very similar to GASB 68, so once again, the terms and the concepts should be somewhat familiar. So this will impact the financial reporting for our employers whose retirees are participating in the Medicare Premium Payment Program. And really the big change that's coming out of this is that it's going to necessitate that they reflect a proportionate share of what's termed the net OPEB liability on their financial statements, along with the associated OPEB expense and deferred inflows and outflows. In the past, under the old standards, these liabilities were just reflected on the plan's notes, so they weren't reflected in the financial statements of either the plan or the employers participating in it. This standard also is going to impact CalSTRS next fiscal year because we're going to have to implement it and reflect our proportionate share of the state's unfunded liability for healthcare costs and dental costs on our financial statements. And at June 30th, 2016, the state's unfunded liability associated with these costs was approximately $76 billion. So the purpose of the changes, so prior to GASB 74, 75, we were operating under GASB 43, 45. And those standards came out approximately 2004. And over that course of time, the GASB has been reevaluating, reexamining both the pension and the OPEB standards to see if they're meeting the original objectives. And through numerous projects and due diligence processes, they came out with first 67 and 68, and then subsequently 74 and 75. And a primary goal of GASB 74 and 75 is to align them with 67 and 68 because pension and OPEB benefits are very similar. They want to make sure that the accounting and the financial reporting for them are consistent across those sets of standards. In addition to that, along with GASB's normal reasons for issuing new statements, is to improve the transparency, in this case, the transparency around OPEB costs and the OPEB liabilities, and it's also to promote consistency and comparability across the different sets of financial statements that plans and systems issue. So again, similar to 67 and 68, the fundamental change coming out of these standards is really to separate the funding perspective from the financial reporting perspective. So under the old standards, it was done more from a funding perspective. We were required to display the ARC for the plan, which we're no longer have to do under the new standards. So what this is going to result in is that for our plan, for the Medicare Premium Payment Program, we're going to have two valuations one for funding purposes, and then one to support the actual financial reporting and accounting. So again, being the accountant that I am, I'm probably going to go into too much detail, but I'll try and bring it up a level. So with regards to the changes, under the old standards, we had what was called the unfunded actuarially accrued liability. Under the new standards, it's termed the net OPEB liability. So the two are kind of fundamentally the same. It's just the way that they're calculated is a little bit different. Yes.
Can I interrupt and ask a question? So you're talking about an unfunded liability, and I know with GASB 67 and 68, we're doing a proportionate share of the unfunded liability. What confuses me is if I go back to the actuarial report for the Medicare premium payment plan, we're 100% funded. So what is the liability or the obligation that we're trying to measure if we're in fact 100% funded from an actuarial standpoint?
Again, that goes back to the decision that the board made wisely not to transfer the assets.
Yeah.
And so in the accounting records, there are no assets in this particular plan.
Oh, okay.
Yeah.
They're zero. So basically, it is in fact, although you are funded within the context of the valuation, you're completely unfunded from an accounting perspective.
So because the assets weren't set aside.
Well, that makes a lot of sense.
So again, the accounting standards are kind of.
We love this,
strict.
Paul. I want you to know that.
Okay,
We have
we're
had
supposed to love
GASB
this?
on the
Good.
phone.
Okay.
We have.
Okay.
So,
Sorry for the interruption.
no, that's fine. So again, the accounting standards accountants are strict, right? So because the assets weren't actually transferred, we have to show it as not being funded. So we don't reflect them in the financial records. So again, that's kind of one of the changes coming out of this. Again, this kind of leads back to that, the employers are going to have to reflect a proportionate share of this net OPEB liability on their financial statements, where in the past it was just reflected in the notes of our financial statements. It recasts OPEB expense. So under the old standards, OPEB expense or cost was really defined by the contractual required contributions that an employer was supposed to make to the plan. Under the new standards, it's really results in the OPEB expense is really the result of the changes from the net OPEB liability from one year to the next. And then finally, like all accounting standards, it's going to require a lot more robust note disclosures and information. So we'll have to provide information on the year-over-year change in the net OPEB liability and what's caused that. We'll also have to provide additional information with regards to sensitivity analysis on how changes in the discount rate and or in the healthcare trend rates impact the net OPEB liability. And then there'll also be some additional supplementary schedules that we have to provide. So again, similar to 67, 68, it has this, GASB 75 has this concept of the blended rate. And so what this is, it's really, so if your plan has sufficient assets to cover the obligations, you would use your regular long-term assumed rate of return to discount it for valuation purposes. But to the extent the assets aren't sufficient to cover the obligation, you would use your long-term rate of return up to the point of depletion, and then you have a crossover, which is what we call it. And then after that, you would use a high-quality municipal bond rate to discount the rest of those expenses, and so you end up with sort of this blended concept. Because the MPP program, from an accounting perspective, isn't funded and it's handled on a pay-as-you-go basis, there are essentially no assets in the program. And so the crossover period is probably essentially going to be day one. And so really what we're going to be using is the high-quality municipal bond rate for the discounting purposes. Again, under the old standards, we were allowed to amortize changes or differences between the expected and actual investment returns over 30 years, or over a maximum of 30 years. The new standards require it to be over a 5-year period. And it also requires that we provide information on the money-weighted return of the investments or as a plan, to measure the performance of the plan and the investments. So some of the other actuarial considerations, under the old standards, plans were allowed to use they had 6 different options in terms of the cost attribution approach that they could take. Under the new standards, there's only one approach allowed, and that's the entry age normal. And then finally, as we were talking about, there's really going to be 2 valuations performed, one for funding purposes and one for accounting purposes. And so, because one shows it as totally funded and the accounting perspective shows it as unfunded, we're expecting that we're going to get a number of questions from the employers and auditors as they go to implement GASB 75.
How many, if we have 7,000 participants, how many employers are participating?
Over 600.
Over 600. Okay. Still a lot.
And I'm going to caveat that, and we're going to get to that. It depends on how you count them.
Yeah. It depends on their accounting policies. So, yeah. So I'll say this program is very unique, and the challenges that is presented from an accounting perspective, from a conceptual, have been very invigorating and intellectually stimulating. So something accountants love. But so this right here is an example. It's a simplified example of a disclosure that we would show in our financial statements, and it's using information from the 6/30/2016 valuation. So the total OPEB liability at that point was $315 million. We would show that there's no net position in the program, net assets to cover that cost. So the net OPEB liability would be $315 million. And so, you know, the employers that are participating in this program or have members participating in it would have to show their proportionate share of this liability. So now I'm going to hand it off to Lucy, and she's going to provide you, go over some supplementary schedules that we're going to prepare to assist the employers in their implementation of this standard. So.
Thanks, Art. So, as Art had mentioned, because of the implementation of GASB 75, the employers will be required to book a proportionate share of our OPEB liability and our OPEB expenses and deferred inflows and outflows. So for this coming fiscal year, we will be providing additional schedules in our other pension information, which is really 2 options for them to book their proportionate share. For the current year, management had decided to provide 2 methodologies in calculating the proportionate share. One is going to be based on the strip employer contributions, which is really consistent with what GASB is saying in their standards. However, the Medicare premium payment program really is based on retired members, and so there are no direct contributions that is related to the Medicare premium payment program. So we decided to provide a second option, which is really basing the proportionate share on actual Medicare premiums and surcharges paid for the current year. It is also good to note that at the end of the day, the employers will have to adopt a policy and make a decision on which methodology to use if they so choose to use our proportionate share. Something to also note too is that since employers will be required to book this liability next year or fiscal year 17-18, by us providing this additional information to the employers, it will minimize, if not eliminate, questions from both employers and their auditors in terms of like, well, how do we calculate our proportionate share, or what information do you guys have to assist us in booking this liability and this expense? So I'm sure this has been mentioned in so many different slides. The GASB 75 will increase our employers' OPEB expense and liability, but it's really relatively small as compared to our strip pension liability. I would say, as in previous slide, the OPEB liability is estimated to be about $300 million, and as compared to the pension liability, which is over $60 billion, based on last year's number. And so the next 2 slides really is just showing the impact of the net OPEB liability depending on which methodology the employers would pick. So for this particular slide, if the employers were to choose on using this proportionate share contributions from a small school district perspective, their liability would increase by about $200,000. From a medium school district perspective, it will increase by about $1 million, and from a large school district, it will be increasing to about $14.9 million. And this is spread across over 1,700 school districts. On the next slide, this is just showing you that if they were to choose the other one, which is based on actual Medicare premiums and surcharges paid, The small district would have increased their liability by about 300,000. The medium school district would increase by about 4 million, and then the large school district would increase by about 89.3 million, which is spread across over 600 employers. So consistent with 67 and 68, we will update our CalSTRS.com GASB accounting changes website. We will add resources, including FAQs specifically for GASB 74 and 75. We will hold meetings and also webinars if needed. And then lastly, the key takeaways, like Art had said, this really is just impacting the financial reporting aspect of the Medicare premium payment program and has nothing to do with the funding. And consistent with what I said a few slides back, is that the impact to the employers is that their liabilities and their expenses would go up, but relatively small as compared to the pension liability from the strip. And then I would entertain any questions.
And maybe I'll just re-clarify the distinction between the two approaches that we're providing to the employers. One is based on what I would call the asset side or the revenue side, where it says, this is your proportionate share of contributions to the program, so how we're getting the money to pay the benefits. And then the benefit-based schedule is, this is your proportionate share of the liability portion of the program. This is your share if we're looking at the outgoing payments of the premiums to the Centers for Medicaid and Medicare Services. So we have really struggled with this, and we've done consultations with GASB because the statements were not designed with a program like ours in mind. It was really, they were really set up to deal with situations where the contributions to pay for this benefit were an ongoing contribution, not something that was set aside. And because as we have done our research and analysis over this schedule and its impact to CalSTRS, we discovered that those approaches give very different numbers for certain employers. We wanted to make sure that we gave them the information so that they could either, as Art indicated, set their own policy or adopt one of the approaches that we're providing information for. But it was difficult to make a choice because it really depended on the perspective that you wanted to take. And based on your situation as an employer, one might make more sense than the other. The conundrum that creates is that the liability as it gets distributed across the state of California is not necessarily going to even come close to adding up to the whole. So therein lies the fun of accounting.
Any questions? So I have a question. So what is, so there's 600 employers and there's a supplemental schedule like we do for GASB 68, right? Crow gets involved in that. They do some auditing of it. But the activity is only at our end. I mean, right? I mean, right now, all that's happening, there's no more contributions coming in, correct? So all that's happening is we, CalSTRS, are writing checks to Medicare for the payment of premiums for these 7,000 participants. So is there anything to audit at the district level, the employer level? I mean, what is Crow's involvement here? And do they need to be involved at all, or do we need to be involved at all, even in looking at the individual districts?
So the first schedule, the one that allocates based on the contributions that are coming in, is really a subset of the schedule they're already auditing for 67. So
I thought there were no more contributions coming in.
Well, there aren't, but one could, if you were dividing the proportionate share of the liability based on the contributions of the overall employers in the state, which is one method. I'm not.
Right.
That
but
is one.
I thought there weren't any contributions.
Well, so again, this has to do with the concept of, and this is the theoretical conundrum. Initially, the set aside was for contributions that had been provided by all employers. Although that happened in 2000 and prior, one could argue that the way to set the proportion is based on the same proportion that you're using for the entire state teacher's retirement plan or the strip.
Oh,
Okay, so that's one way of viewing it. The liability way of viewing it is saying that another representation of how to divide the liability is based on the people who are actually participating. And that's the premium side. And you do get significantly different results, particularly for certain employers.
That's why they did both.
And we have been in discussions, like I said, with Gatsby and Crow, Dr. Yetman, on our approach because of the way this doesn't really fit the model. Did I answer your question?
so let me just get, I mean,
So back
how
to
much
Crow.
additional work is involved at the district level for our staff or for Crow?
No, I don't think it's measurable.
Okay. thank
Okay.
you. Okay,
Inconsequential. This year, we've spent time on this as we get going.
sure.
I don't see it as a measurable delta from what we're already doing. We have had to go through the education process.
Okay. Well, I think everybody else on the committee understands this perfectly because I have no questions. So thank you, Art and Lucy, very helpful. Let's see, we have a review of information requests. Did we have any?
No, we did not.
Okay, good. The draft of the agenda for the next committee meeting. Anybody have any thoughts, comments? Did you? No. Okay. Opportunity for statements from the public. I don't see anyone. So I think we're adjourned. Thank you.